Hello everyone, good morning or good afternoon depending on your location, and welcome to today's webinar on improving your risk management disclosures in line with the TCFD recommendations. This webinar forms part of our TCFD implementation series, which takes a deep dive into each of the TCFD's 4 core elements. If you haven't already signed up for other episodes in this series, we do encourage you to do so via our website at cdsb.net. This webinar series comes at a time when climate risk is high on agendas worldwide and climate-related financial disclosure is increasingly gaining prominence. Already this year, we have seen the results of the WEF Global Risk Report, and for the first time ever, the top 5 global risks in terms of likelihood are all environmental. And just last week, Larry Fink stated that in the absence of robust disclosures, investors, including BlackRock, will increasingly conclude that companies are not adequately managing risk. So with that in mind, I'm thrilled to welcome you all today to today's webinar and to introduce our speakers. Gemma Restelli is the Senior Manager in the Sustainable Finance team at HSBC Holdings, covering the group's environmental, social and governance approach. In this role, Gemma is responsible for the annual disclosure of the ESG update, ESG investor relations and the TCFD for the HSBC group. Nontokozo Kumalo is Corporate Engagement Manager at the Climate Disclosure Standards Board, where she supports companies with reporting on climate-related and environmental issues. She has several years of experience in the financial sector and with this, the banking and asset management. And I'm Leslie McKenna, the Communications Manager here at CDSB, and I'll be your moderator for today. In terms of housekeeping, if you would like to submit a chat or a Q&A to our panelists, we will run a questions and answers session at the end. So we do encourage everyone to submit all their questions using the Q&A function on the right-hand side. And if we do not get an opportunity to address all the questions at the end, you can reach out to us directly. If you're having any problems with audio or viewing the slides, please also drop me a note in the Q&A function, and we do also encourage everyone to turn up the volume so that you can hear us all loud and clear. We are recording this session and we will issue a copy of the recording along with the slides after the webinar. So before I dive into the presentation, I invite you all just to participate in a short poll. This poll isn't public. This is for our own knowledge, and it's to help us gauge a level of understanding of your knowledge of the TCFD recommendations, and this will help us tailor our content and our resources in the future to ensure that you have the right tools at hand to enhance your disclosures in line with the TCFD recommendations. So using the poll tool on the right-hand side, the question that we ask is, how would you describe your understanding of the TCFD recommendations? So you can select A, I'm an expert, B, I'm confident, C, I have some knowledge, and D, I have little knowledge. The poll is now open. It will remain so for the next 2 or 3 minutes, and we thank you all for participating in this. And with that, I will now pass you over to Nontokozo, who will present on our work here at CDSB and explore the current state of TCFD disclosure to date.
Thank you, Leslie, and to all of you that have kindly joined us today. Before proceeding on to the recommendations and today's element of focus, it is probably useful to start with a bit of background about who we are, which should provide some context on why we're presenting these topics. We're a consortium of 9 environmental and business NGOs set up in 2007 at the World Economic Forum in Davos, having observed the link between climate change and financial performance and the existence of a gap with regards to integrating these issues into annual reporting. We're chaired by the World Economic Forum and are supported by a technical working group of over 40 experts. Some of the experts and board members can be seen on this slide. Our work at CDSB is summarized by our mission, which is to create enabling conditions for the integration of decision-useful climate and natural capital information into mainstream reporting. We achieve our mission by offering a framework for reporting environmental and climate information in the mainstream report. Next slide, please. The CDSB framework consists of 7 principles and 12 requirements. The 7 guiding principles are about the how of disclosure. Then the 12 reporting requirements are about the what of disclosure and mainstreaming of climate and environmental information. The framework is fully integrated, fully aligned actually with regards to the TCFD recommendations and principles. Also interesting to note is that the TCFD recommendations were developed based on the CDSB framework and other leading reporting frameworks. Therefore, the CDSB framework is complementary to existing reporting provisions such as CDP, GRI, as well as SASB. The framework is referenced in the EU NFR derivatives guidance and by stock exchange guidance globally. Next slide, please. So why were the TCFD recommendations introduced? Why are they important? Over the past couple of years, we've seen an increased acknowledgement of the need for climate action, and even with the most ambitious of policies, it is starting to seem unlikely that we'll be able to limit global warming to 1.5 degrees. According to Climate Action Tracker, policies presently in place are expected to result in about 3 degrees warming above pre-industrial levels. These climate-related issues have a potential impact on financial stability, which has meant that the role of investor capital allocation decisions has become even more apparent, as has access to decision-useful climate information. Investors and other financial players seeking decision-useful information have, however, been faced with several challenges, and some of these are seen on the slide. Lack of disclosure on the financial implications on climate-related aspects, inconsistencies in disclosure practices, lack of context with regards to the information, and use of boilerplate and uncomparable reporting. It is against this backdrop that the industry-led task force on climate-related financial disclosures was set up by the Financial Stability Board. It was set up to develop a set of voluntary, consistent climate-related financial disclosures that would be useful to investors, lenders, and insurance underwriters in the understanding of material risks. The recommendations launched in 2017 have received widespread support and are seen as best practice on governance globally. The recommendations consist of 4 elements: governance, risk management, strategy, metrics, and targets. The first thing you notice about the 4 elements, as you can see on the slide, is that they are similar to traditional organizational descriptors. This is deliberate, as the recommendations are actually meant to fit into existing language of business. The second aspect is that elements are shown as a concentric circle, because they are interconnected and not meant to be considered in isolation from each other. There are other things to note about the recommendations, as you can see with on the left, some of which I've already touched on. They are, for example, voluntary, and despite this voluntary aspect, it's important to also be aware that governments around the world are actually starting to conclude that a mandatory approach is needed to ensure necessary uptake at scale. The disclosures are meant to be made in the mainstream reports. Several G20 countries actually already require public companies to disclose material information in mainstream filings, and this may also include climate change. The task force actually intended that these recommendations support country requirements. There's also the expectation that disclosure in mainstream reports could ensure that climate-related information is subject to controls similar to those applicable to financial information. The recommendations are for all companies, but with particular focus on financial and high-risk non-financial sectors and how these sectors might be affected by transition and physical risks. Opportunities that emerge from climate change should also be disclosed, so the focus is not just on risk. The task force also recommends that companies conduct scenario analysis to explore how different combinations of climate-related risks might affect the resilience of the company. Companies must describe short, medium, and long-term climate-related risks and opportunities. The TCFD does not define the time horizons, but rather suggests that companies consider what is relevant for them and their assets. Disclosures can be both quantitative and qualitative. Next slide, please. Next slide, please. Thank you. So what does market practice look like? The second status report, which was released in June last year to monitor and inform progress against the recommendations, has a few findings that we'd like to highlight on this slide here. So some of these is that include, despite the support for TCFD rising, companies are still finding it a challenge to implement the recommendations, resulting in insufficient disclosure for investors. More clarity is needed on the financial impact of climate-related issues. The majority of companies do not disclose on resilience, and mainstreaming climate-related issues requires the involvement of multiple functions in the organization. So uptake at scale is urgently needed. We have a globally agreed framework, but companies are not using it as intended. And then when you look at the analysis of disclosure shown here, you can see that particularly the banking sector has been the strongest over the period that they looked at. And the banking sector actually performed well across all the elements, not just the risk management elements shown here. And this is probably because of the existing processes and structures that already characterize the sector. And we can also see a higher disclosure in the EU. Next slide, please. Thank you. Now let's look at the risk management element more closely. This element actually happens to be one of two disclosures where there's no requirement for materiality in order to disclose. Risk management and governance are core elements, which are about how the company manages climate change and what the internal processes are. They address the investor need for context in which financial and operational results are achieved, hence that there's no need for materiality. There are three main disclosures under the risk management element, but these can actually be looked at, can be viewed in two parts. Firstly, how are climate-related risks identified, assessed, and managed? This refers to the first two disclosures. Then the third disclosure, disclosure C, is about how climate risk management processes are integrated into the overall risk management processes. Next slide, please. As I've mentioned, the TCFD recommendations introduce two types of climate-related risks, those relating to transitioning to a low-carbon economy, known as transition risks, and those relating to the physical impacts of climate change, known as physical risks. For the benefit of everyone, it's probably useful to further clarify that transition risks include policy and legal risk, technology risk, market risk, and reputation risk, while physical risks include acute risks, such as the extreme weather events that could occur, and chronic risks, such as sea level rise. Next slide, please. Now, to consider the three disclosures in more detail. The first recommended disclosure is that companies describe processes for identifying and assessing climate-related risks, as mentioned. It is suggested that companies consider including a discussion on the following: how the relative significance of climate-related risks versus other risks is determined, and the processes for identifying the potential size and scope of risk. Whether existing and emerging regulatory requirements related to climate change are considered. A discussion on risk classification frameworks used. For example, with banks, the Enhanced Disclosure Task Force framework on defining top and emerging risks could be used. Another suggestion for banks, although there's no reason why this approach could not apply elsewhere, is that banks consider characterizing their climate-related risks in the context of traditional banking industry risk categories such as credit risk, market risk, liquidity risk, and operational risk. Next slide, please. We then come to the risk management. Okay. We then come to the risk management aspect. How are the companies managing climate-related risks that they've identified and assessed? The guidance with regards to recommendations suggests that when describing risk management processes relating to climate change, companies consider a discussion on how decisions to mitigate, transfer, accept, or control these risks are made, and also how climate-related risks are prioritized, how materiality determinations are made within the company. A useful way to go about determining the relative materiality of climate-related risks and how these should be prioritized is by conducting a materiality assessment and incorporating a materiality matrix. This is already being done by several companies, And ensuring climate-related issues form part of this is really just a minor next step. Thank you. Next slide, please. The final disclosure is about integrating or embedding the processes for identifying, assessing, and managing climate-related risk into overall risk management. In describing how climate-related risk management processes are integrated into overall risk management, we suggest that companies take a direct approach or an implicit approach. A direct approach would mean the inclusion of a brief discussion regarding the inclusion of climate-related considerations into overall risk management processes. Or as we have seen with some companies, you can talk about the risk management processes broadly and then just mention climate change within that. Alternatively, where climate change risk has already been included alongside the list of company risk types, it can be implied that when discussing overall risk management processes, climate change forms part of that. Next slide, please. Since investors are the ultimate users of the disclosed information, it's fairly important to constantly be aware of their information needs. What are the aspects, particularly with regards to risk management disclosure, that investors have indicated that they want to know? We thought we should share some key takeaways on what constitutes decision useful information from an investor survey on TCFD disclosures conducted by one of our board members, SASB. Survey respondents identified the value of having clear definitions of the categories of risk and specific channels of risk the companies identified as material. Greater clarity around the process by which companies prioritize risks and how this prioritization may change over time in response to actions taken by the company to mitigate this risk. More information about companies' risk management process, how that informed board decisions around strategic resilience. Next slide, please. Thank you.
Thank you very much, Nantakozo. And that brings us on to Gemma's presentation from a banking perspective. Thank you very much, Gemma. I'll hand over to you now.
Hi, Leslie, and thank you all for joining. I just wanted to start by giving a brief background as to the way that we think about kind of the broader topic around ESG at HSBC. So just to give a bit of context as to how the kind of climate piece fits within that. So the main lens that we look at ESG through is through our stakeholder lens. So we focus on these key customer groups. First of all, we think about what are the important things to these stakeholder groups. So from a customer perspective, more and more consumers are choosing companies who value environmental, social, and governance factors. From an investor perspective, we complete an annual ESG investor survey. And what we found is that more and more of our investors expect us to have ESG metrics tied to our strategy and also ESG-related metrics tied to executive compensation. And obviously within the E of ESG, environment and climate is kind of key to that. Within the other stakeholders, the board and our executive directors are pushing us more and more from an environmental perspective. They're taking kind of external training courses as well as us running internal training courses for them on climate. And we're being asked more and more and being pushed more and more by those kind of internal stakeholder groups. In addition, our employee surveys tell us that new graduates as well as current employees, it's something that people value. They want to understand what we're doing in this space and kind of pushing to make sure that we're kind of in line with our peers and our competitors. We held a graduate event around 6 months ago with 1,000 of our new graduates. And a number of the questions that were raised were around climate and what is HSBC doing and are we doing enough? And then in terms of regulators and governments, it's already been touched on that although TCFD is not currently mandatory for us as HSBC, at some point, some of the kind of governments and regulators are kind of moving towards that. Also, we listed on 2 stock exchanges, and Hong Kong and UK do have kind of ESG related listing rules to bear in mind. Those things deliberately talk about materiality, and again, it's kind of up to us to decide what is material from an ESG perspective. We do that through understanding what's material to these stakeholder groups. And off the back of all of this feedback that we've gathered from these various groups, climate is something that is top of the agenda for a number of our stakeholders. So that's kind of the kind of broader stakeholder piece around ESG. And then just moving onto the next slide, and I'll try and tick through this quickly to get onto the TCFD piece. But the next slide is really the key elements that we cover from an environmental, social and governance perspective, just to give you an idea of the types of themes. You can see the boxes at the bottom are the areas where we've embedded ESG into our strategy. So as an example, the first, the US 100 billion sustainable finance target, is part of our strategic priority number 1. In addition, we've got to improve employee satisfaction, employee engagement, and we've got, it's part of strategic priority number 8, to achieve an ESG outperformer according to Sustainalytics methodology. But focusing on the green, so the piece on the left-hand side, there's kind of 2 main elements in the E of ESG. So the first is our own operational sustainability, so our own carbon emissions as a bank. And then the second is the low carbon transition. So how are we helping our customers to move towards a low carbon economy? If we could just move on to the next slide, that'd be great. So diving more deeply into the E, into kind of what we have within our kind of current TCFD disclosure, we talk on the bottom left about our own operations and how we are seeking to increase our renewable energy percentage. We're targeting to have 100% of our own electricity from renewable sources by 2030. But really, the more material piece for us is how are we helping our loan book and our customers to move to a low carbon economy? What are we doing to help them? And I suppose that's the key point that we've tried to make anyway through all of our disclosure and all of our communications. It's not that we're necessarily walking away from customers. What we're hoping to do is help them to move through financing. So that's something we're quite clear about to our investors. You can see that we've made an external commitment of 100 billion of sustainable financing and investment to be provided and facilitated by 2025. This progress, 28.5, was as at the end of 2018. We're actually publishing our annual report on the 18th of February, so in around a month. So that number will obviously be updated. And then diving into the core bit of our TCFD disclosure from a risk management perspective. So the way that we think about climate risk at HSBC is really in kind of 2 buckets, as has already been mentioned. So there's the physical risk piece in terms of how that will impact our customers and our clients. So we try and think through, particularly for our retail bank, you know, what would flooding actually look like? How many of the houses and mortgages that we've kind of financed would be underwater in certain scenarios? From a transition risk perspective, it's more understanding how, if we move to a low carbon economy tomorrow, which of our customers would be impacted by that. So how many of our customers are in what we call kind of high transition risk sectors, so oil and gas, for example. And I suppose that's where we've got to with this disclosure. So what we're saying with these numbers is that 20.8% of our wholesale lending book, so that's around 600 or 700 billion, is to these high risk sectors. So what we're trying to demonstrate through this disclosure is this is our exposure. This is kind of where we're potentially exposed to transition risk. But then also what we're saying is that this is an opportunity for us to help these customers to transition. So in terms of how we've got to this point, this represents our second TCFD disclosure. So just to kind of walk through those concentric circles that were talked through earlier. The first thing that we did is we ensured that we kind of got the board on side, if you like. So we ran, this is kind of over a number of years, so we ran kind of like training sessions, etc. for the board, and then also our group management board as well. And what the point we've got to now is that climate risk is viewed by HSBC in exactly the same way as any other top and emerging risk. So we have it on our top and emerging risks framework alongside geopolitical risk and cybersecurity risk, just as an additional risk that we're looking at in exactly the same way. It's actually measured and monitored within our credit risk department at the moment. And again, it's monitored in the same way, so it kind of feeds through the same kind of annual review process that any of our other risks would look through. The key other element that we've introduced in the last 12 months is transition risk questionnaire. And I suppose this goes back to what I was talking about in terms of helping our customers as opposed to necessarily walking away. So what the risk team did is they've developed a questionnaire that sits exactly alongside our analytical review process. So when relationship managers are reaching out to our clients and walking through the normal annual review process, they will also be running through our transition risk questionnaire. And that will be asking questions around what is your climate strategy? What is your board policy? What is your management plan around climate? What would you do in this scenario? What are you planning to do if this happens? And just kind of driving some of those conversations to understand how our customers and our clients monitor how our customers and our clients monitor those scenarios and that risk, partly from a risk management perspective, but then also from an opportunity perspective. Because it might be that they say, in an ideal world, we'd want to be doing this, want to be doing that, but actually we need some extra financing to do that. And then all of a sudden it's an additional financing discussion for us. So what we're hoping is that we'll be using those questions to really drive opportunities and therefore help our customers to move to a low carbon economy. So what the kind of learnings that we've taken from this process are really that once you start to measure and once you start to think about the potential impacts of these kind of scenarios, it really helps to drive a lot of conversation across the group, and particularly in terms of how we're helping our customers. And I really strongly believe that what gets measured gets done. So as soon as you start putting numbers on a piece of paper and showing them to people, it suddenly drives a lot more conversation. You can imagine the volume of conversations that we had around these disclosures before we were able to publish them. The other key point I wanted to make is that the TCFD disclosure is just part of our normal filing. So it's part of our normal annual report in exactly the same way as all of our other kind of risk disclosures. And I think that was everything I wanted to run through. So I'm not sure if there's any specific questions. I suppose the last couple of slides were really just our current disclosure. So you can see this was what we disclosed at the beginning of this year, so the year end 2018. And you can see there where we talk through the transition risk questionnaire, we talk through our policies, etc. And then the next slide is our TCFD disclosure. So you can see that table that I just talked through in the bottom right, and a bit about our strategy and governance.
Excellent. Thank you very much, Gemma. And also, I do appreciate that you mentioned your annual report is coming out the 18th of February, so I'm sure you're very busy. So once again, thank you for taking the time to speak with us today. And also, I think it is quite an opportune time because I'm sure disclosure is quite fresh in your mind. So I think this would be a nice segue into tips for implementation. So I know Nonto Kozo has some tips to share with us from her work with companies who are reporting, and then Gemma, we might hand over to you to give your couple of tips to our audience as well on how to get started and how to pave the way for a successful TCFD journey.
Thank you, Leslie. So these are just really some tips based on research and engagement with companies through the years, as you've already mentioned. And I'll just touch on some of these that are shown here. So the first one is really about adopting the right lens for looking at climate-related risks. We found that some report preparers are confused with regards to the orientation for TCFD. So for TCFD, we're looking at the impact of climate-related risk on the business and not the other way around. So this is important to note. And also make holistic disclosures. As mentioned, disclosures are interconnected, and showing that interconnectivity is key. It includes linking non-financial information to financial information, so that's important. And also explain how you assess the materiality of climate change to your business. We found that this aspect is often missing in many reports, and I've already mentioned materiality earlier. We encourage companies to use existing standards to make disclosures. We believe that companies will find that they've already started really doing what they will need to do with regards to their TCFD implementation journey. It's important to look at TCFD like a bunch of puzzle pieces that help you tell the story of how you assess and manage climate-related risks and opportunities. So we encourage companies to make as many of the 11 disclosures as they can. Finally, the recommendation of the TCFD is that those disclosures are made in the mainstream report. I've already mentioned this earlier, and including these disclosures in the mainstream report will allow the information again to be put through as the similar kind of rigor that financial information goes through. So it allows for key linkages to be made between non-financial and financial information. But overall, we encourage companies to really evolve practice over time, to learn by doing, and to not let perfect be the enemy of good.
Thank you very much, Nantakozo. And just as a reminder, if you do want to submit your question, please do so using the Q&A function on the right-hand side. We've had quite a few come through already, so we will be engaging in a Q&A with our experts after the presentations finish. So Gemma, I will now hand over to you to talk us through HSBC's top tips.
Yeah, so I suppose the main one, and we kind of touched on it at the beginning, is around stakeholders, and the key one being the board. So we use this phrase, getting the board on board, and it's quite key for this type of disclosure and this kind of work. Once it's really is key to get the senior stakeholders on board within the company, get them excited about it, get them talking about it, and then as soon as that becomes something that those people are passionate about, it drives a lot of action, as you can imagine. And then the other piece that I've just jotted down is become an internal disruptor. So I suppose what I mean by that is just kind of ask those difficult questions. So just to give a couple of examples, you might come across somebody who doesn't necessarily think it's something that they need to kind of worry about now, if you like. So asking questions along the lines of, okay, I understand you think it's a while into the future, nothing to worry about now, but if tomorrow the UK government introduced a carbon tax, how would that impact our business? How would that impact our profits? And it's interesting if you start asking those types of questions, how it generates conversation and it generates action.
Excellent, thank you very much. And just to highlight a few useful resources that already exist in the market. I know, Gemma, you spoke at the start of your presentation around education, so I wanted to highlight that on the TCFD Knowledge Hub, climate-related financial disclosures courses were launched last September. So there's currently 3 courses online, one that takes a look at the corporate reporting landscape, then a deep dive into the TCFD, and then also looking at the role of the accountancy profession in tackling climate risk. So we do encourage everyone to do those courses. They are free and they're self-paced as well. Some other useful tools are the TCFD Implementation Guide, which was developed by SASB and CDSB, and this also complements the work of the Corporate Reporting Dialogue, which you can see on the bottom left-hand screen. And the Better Alignment Project report came out also last September, and that maps the 5 main standard setters and frameworks against the TCFD recommendations. So you essentially have a roadmap to be able to implement the TCFD recommendations using the major standard setters and framework providers. And then also looking at the TCFD handbook, which offers good practice examples from companies across the entire G20. So offering examples from both the financial and non-financial sector. And then something I think we also always say as well is look at the existing data that you have. So if you are reporting to CDP, a lot of that data is already there. And then you just need to look at what's material and then pop that into your mainstream report using the CDSB framework. So we will move on to our Q&A now. I've had a couple of questions coming in, and I do appreciate that we have probably a predominantly US-based audience, so a little bit of clarification, I think, on the terminology. So one of the questions that we had around the terminology was, how do we define the mainstream report in the US? So is that the 10K filing, or what financial filing is that? Perhaps Nantakozo, you could maybe provide some insight there, or Gemma, I'm not sure if that's kind of something you could also talk to.
So my understanding is that the 10K filings is actually essentially the mainstream reporting with regards to the US, but I'm not really an expert on that region. But yeah. So it refers to, it's part of mainstream reporting.
Yeah, and I'm afraid in a similar way, I'm just responsible for our group holdings report, so I don't deal with US reporting, I'm afraid.
Okay, excellent. Well, I know from what we have done with SASB in the US, I do think it refers to the 10K filing, and I think it's also worth noting as well that the TCFD recommendations does say that you can put that in the equivalent. So in some regions such as Japan, they have an equivalent report. So you're always looking to align your disclosures with whatever that mainstream annual report is. Thank you. And we will have a look at some of the other questions that are coming through. So we have a question around the role of CFOs. So CFOs are often reluctant to do forward-looking reporting. Have you seen this view being changed?
I think within banks, I think there's definitely a view that forward-looking reporting is becoming kind of, again, mainstream. I know that there's a big kind of IFRS 9 work stream that involves a lot of kind of forward-looking reporting, just off the top of my head. Also, from an HSBC perspective, the Bank of England run an annual stress test, and that's something that involves obviously like forward-looking reporting, at least to the regulators. So I think definitely CFOs are becoming kind of more and more involved with that reporting. And I mean, it's a key part of risk management. It's kind of forward-looking reporting. So it's definitely in the world of the CROs in terms of climate risk. I mean, within HBC, we don't really see that reluctance, to be honest. I'm not sure whether that's at different types of organisation, but I think definitely CFOs see the value in forward-looking reporting, definitely from an investor perspective.
Thank you. And Gemma, just one other question around HSBC's annual report. Do you do a separate TCFD report, or is all that information within the annual report?
Yeah, so the one in 2018, I can see one of the ones about location. So the 2018 annual report, our TCFD disclosure is page 29. So it's embedded within the strategic report section of our annual report.
Excellent, thank you. And then we've got time for one or two more questions, so I'll quickly go through these. What are some of the ways to disclose on the risk management element while showing the link between other elements or areas? So I suppose that relates to connectivity.
Okay, so I think I can answer that one, which is basically we've got some great examples with some companies that we've come across. So there's a Finnish company that actually we really like. They do this well. They show a table which shows all their risks, including climate change, and then they also show the mitigation aspect with regards to the risk, and then they link those mitigation those risks to the different strategic areas of the business. So it's really put in a very simple way, and they just basically show this very well for anybody who's reading the report to understand the linkages there between the strategy side and the financial side. And another way is to link the border oversight discussion around risk to the risk management aspect. So linking the board level, the governance, to risk management in your discussion in the report. I think that's one way.
Thank you, Nontakozo. And then one final question, which is one I think we get asked quite a lot. So as a company, if you're planning to implement the TCFD recommendations but have not finalised all your disclosures yet, is it worth mentioning them anyway, or what's the best way to approach that? Should you wait until they're, I suppose, complete, or is it worth kind of starting and integrating what information you have into the report?
So one of the tips I mentioned earlier was with regards to just disclosing under as many of the 11 disclosures as you can. And it's really okay to start talking about the journey that you want to take ahead. And even if you're not where you think you should be, you can actually just start talking about timelines and where you think you want to be in the certain number of years. And this is actually fine because it actually shows investors that you are really thinking about these issues and you do have a strategy going forward to actually integrate climate risks into your thinking as a business. So we encourage companies to definitely talk about it, talk about what you plan to do.
I definitely agree with that, and I think that just thinking about, there's a lady, Sarah Breeden at the Bank of England, and she's very clear that we should think about it almost in the same way as you'd think about an English essay as opposed to a maths test. So just at least trying to describe the way that you're thinking about it and the way that the organisation's viewing it is more helpful than waiting until you have all the right, exact, accurate answers.
Oh, thank you. And what a lovely analogy as well. It makes it seem a little less daunting. So that is all that we have time for today. I do encourage you, if we didn't get a chance to answer your question, to reach out to us directly. So you can reach us on info@cdsb.net, and then we can direct your question to the most relevant person. As I mentioned before, we have recorded this session, so we will distribute a copy of the recording and the slides. And we do thank everyone for joining, and also to the live programme at the European Union who supports our work in this space. So thank you, everyone. And once again, thank you to our fantastic panelists. And I hope to see you soon on another webinar. Have a lovely day, everyone. Bye-bye.
Thank you.
Thank you.